Welcome to Investors Guide. I'm Faye D'Souza. This is the show that helps you with all of your investments. Now, if you're a woman and you need help with your finances, write to us. Our email ID is at the bottom of your screen. We'll do a special show for you to help you with managing your money. You can send in questions to our Facebook page and you can reach me personally on Twitter. I'll be so glad to hear from any of you, especially if you have feedback about this show. Let's get straight to it. On the show this week, we'll help an army officer who's up on the borders protecting the country. We'll help him achieve his financial goals. In our product review, we look at the UTI Equity Fund and we'll find out if gold ETF is a good option as an investment for a small newborn baby girl. I'm going to bring in Dhirendra Kumar. Dhirendra, thank you so much for joining us. Welcome to Investors Guide.
Thank you.
Let's get straight to our portfolio question. Major Rakesh Singh has written in, Dhirendra, he's 28 years old and he's an army officer posted in Kargil right now. He receives a monthly income of 75,000 rupees. Now, the good thing about the fact that Major Singh is with the army is that he doesn't have to worry about insurance at all. He has 5 lakh rupees in a bank deposit, he has 4 lakh rupees in his PPF account, and he has 3 lakh rupees in liquid funds. So that covers nicely all of his emergencies as well. He makes a monthly contribution of 15,000 rupees to the Defence Services Officers Provident Fund account as well. Now, he's written in with various things that he wants help with, Dhirendra. He's looking to get married in the next 1 year. He says he'll need about 5 lakh rupees for the wedding. His sister will marry in the next 3 years and he's going to need 4 lakh rupees and he hopes to buy a car as well. Over the long term, he wants to buy a home in 10 years. And he wants to plan for the education and weddings of his 2 children. Remember, he's not married yet, but he wants to plan for his children and for their future and his own retirement. So all of that put together, he's also sent us a list of his mutual funds. First thing at a time, Dhirendra, can he use the liquid funds in his fixed deposit and his liquid mutual fund towards the weddings that he wants to plan for?
His own wedding and his sister's wedding. And even buying the car, that can all be achieved with his, liquid fund and the fixed deposit, because that money is not needed, it's not needed tomorrow. So he is very well prepared, and I think he already has all the money he needs for his sister's wedding and his wedding. He will have some incremental savings to buy his car for the 2 lakh rupee contribution he wants to make. And all his long-term goals, the kind of investment he's making, and if he's disciplined about it, and maybe just managing it periodically meaning even if he's able to do an annual review, he'll be easily able to achieve all his goals.
Major Singh, I'll give you some good news. If you continue to invest exactly the way you're investing in your mutual funds right now over the next 20 years, which is your shortest time horizon, and it gives you 12%, and we expect so much more from our market, you'll have about 4 crore rupees at the end of that, which means that you're on track, and if you keep increasing your investments as you make more money, you'll do even better. Dhirendra, let's take a look at his mutual funds. iProof Focus Blue Chip, we talked about that last week. Birla Sun Life Frontline Equity, IDFC Premier Equity, Franklin India Blue Chip, HDFC Mid Cap Opportunities, ICICI Prudential Top 100 and Axis Long Term Equity. They're all excellent funds. Would you like to tweak anything about that portfolio? Do you think it's fine the way it is?
I think all of them combined together make it a very low maintenance portfolio. He does not, and he's able to achieve great diversification, and also the highest quality skill available in Indian fund management industry is working for him. Because none of his investment is concentrated in 1 or 2 fund companies. So in that sense, the way his money is spread, I think he just needs to do. He should not be adding any more fund, reviewing it annually, and he's on to a great financial future.
All right, Major Singh, 2 thumbs up for you and your portfolio. Don't make any sudden changes. And of course, we're here to help you. A big shout out to all of our officers and soldiers on the border. We're always here to help you if you need any help with your money. Moving on, let's look into our hold or sell segment. Well, Dr. Nitin Kaushik has written in. He says he's 43 years old. His wife is 39. They both have life covers and health covers, so there's nothing to worry about there. They've been investing 1.5 lakh rupees every month in equity mutual funds, Dhirendra. He says he needs a lump sum amount after 6 years for his son's education and again after 10 years for his daughter's education. And he'd like to buy his daughter an SUV in 5 years' time. He wants to also receive a monthly income of 2 lakh rupees when he retires. Is his portfolio on track for all of these things? So he have varied time horizons, but let's take the shortest one, which is 5 and 10 years. The Franklin India Blue Chip Fund, he switched from Mirae Asset into this fund. Virendra, continue that investment?
No, I don't understand the rationale for this switch, because Blue Chip Fund was a relatively is a large cap fund, is a more stable fund, and Mirae Asset there are two funds on offer here. I don't know which exactly, but either of the two would have been a superior choice, because one of it is diversified and the other one is a mid-cap fund, and both funds have the potential to deliver superior return than Blue Chip. Blue Chip Fund, great history, great focus, but in terms of return potential for somebody willing to assume little risk, the other two Mirae funds would have been a better choice.
First, I'm going to take a look at the funds that he's stopped in his portfolio, which means that he's holding these investments, Virendra, but he stopped all of his fresh SIPs. He has the Birla Sun Life Frontline Equity Plan, the Birla Sun Life 95, SBI Magnum Gold and HDFC Equity. Now, the SBI Magnum Gold I'm not very happy with, but the other three, should he have stopped those SIPs at all?
No, he should not have. In fact, these are exactly the kind of fund which one should continue with. If you really, if you stop your investment into a gold fund because you changed your mind, or the outlook changed, or you started it in the first place because you were getting carried away by the big bull run in gold prices. So from that standpoint, gold is certainly worth discontinuing, and I'm confident that over the next 5-10 years, equity or Indian equity or investment in Indian equity fund or a well-managed Indian equity fund would handsomely beat gold. But the two funds where you have stopped your SIP, I think it will make sense to, if possible, it will be good if you can restart your SIP. These are the kind of fund which you should be investing regularly. The balance fund which you have discontinued, it entirely depends. If you have your investment for 5 years and you plan to take that out, maybe the balance fund might be the right way to approach that. But unless you have segregated your portfolio for different goals, if this happens to be an aggregated long-term portfolio, then you can do without the balance fund.
Well, Virendra, he also has the ICICI Prudential Discovery Fund and he has Mirae Asset Opportunities. Would you recommend he continues both of these as well? Yes,
both funds are very impressive funds, and if he has his investment here, I don't think I can even persuade him to sell, or he won't get persuaded. These are blockbusters, and also at the same time, I think the performance is quite sustainable, given that the approach of their investment or the approach they follow, they stick to it, and in a full market cycle, it should turn out to be a very nice experience.
Next on his list, the HDFC Top 200 Fund. Virendra, continue this investment as well. Remember, he already has HDFC equity, so there is an overlap there.
If he has his money already invested in HDFC equity and he is, going to do his SIP, then there is a big part of the portfolio is common. So and if one has to choose one of these two funds from a long-term perspective, I would go for HDFC equity.
All right, Mirae Asset Emerging Blue Chip Fund also on his list. What would you recommend he does?
This fund has been a blockbuster, and if he is able to withstand the ups and downs, of course there has not been as much of ups and downs compared to most other mid-cap funds. This is a good fund to have, given that the changed market complexion, and he is a long-term investor.
Axis Midcap on his list, Virendra, along with ICICI Prudential Global Stable Equity. Would you recommend he continues both of those? Axis Midcap has been quite a performer.
Yes, Axis Midcap has been a great performer, and it's a very impressive fund given the limited history, despite the limited history, because it has not its investment process, which is so focused on the quality of company. Because many a times funds do well, but it may not be a sustainable method, because it could be the momentum stocks or not so high quality portfolio, which can throw nasty surprises as and when the markets turn around. This fund has been built in the lean times, and I think this fund has taken its lesson. If it continues its approach, or if it retains its focus, then I think it's a great fund to have.
Last fund on his list is the ICICI Prudential Balanced Advantage Fund, Dhirendra. Continue to hold on to that one as well?
No, given his investment time frame and given his return expectation, I think he can do without the balanced fund. He should approach his near term. He should approach with a separate portfolio, either into a fixed income, accumulating his savings into fixed income, or moving his a part of his equity money into fixed income for his near term goals. A balanced fund, unless until he's clearly segregating that these two balanced funds, of course this is a good balanced fund, but it doesn't fit in here given his other investments.
All right, so that's the advice you're getting right now from Dhirendra Kumar. Remember, if you have any more questions about your portfolio, write to us. Email ID is on your screen. Dhirendra, we have a very interesting question coming up for you next. Gagandeep Singh has written in. He has just begun working. This is his first job. He takes home a monthly income of 25,000 rupees. He wants to set aside 10,000 rupees every month. And he has a very specific need. He sent us the asset allocation. He says 60% equity, 20% in mutual funds and the rest in FD. Obviously, mutual funds there, he hasn't been able to understand that split doesn't really make too much sense. Now, he's already investing in the UTI MNC fund and the UTI Pharma fund. He wants to know if he should continue with these investments. His risk appetite is low. What fund should he invest in? Which means that for Gagandeep, we have to start from scratch right now and explain to him what sort of mutual fund he should be using, because with someone with a low risk appetite, he has no business being in the pharma fund at all. What advice do you have for him?
I'll simplify his approach, or I'll contribute to his, clarifying or the approach he should follow. One is that Gagandeep will be earning 3 lakh rupees a year, so he should clearly think in terms of his first investment should go, a part of his investment should be made in a manner that he's able to take the tax rebate. And so the amount which he needs to invest so that he does not have to pay tax should find its way into a tax saving fund. Besides that, his first accumulation of savings, he should not think in terms of investing, but he should just do a quick evaluation or some estimation of his emergency requirement, just in case he is stranded somewhere, how much money he should have, and that money should be lying in a savings bank account linked fixed deposit, which is accessible to him anytime. Then I think he should start his investment process. And to begin with, the kind of allocation he is looking at, for his investment to work, he should just take note of 2-3 things that most investors will be better off not investing lump sum, not trying to put his money. Of course, this MNC fund is moderately diversified, but given the dominance of MNCs in certain sectors and complete absence of MNCs in certain sectors, this is not a diversified vehicle. And pharma fund by its design is not diversified, it is focused on one sector only. So these are avoidable funds for somebody getting started. The kind of allocation he is targeting, he should start with if he is left with more money, then he should consider a balanced fund, one balanced fund, do it and do his SIP for 2 years, and then think more, and you will have a far superior comprehension of what market is, what market linked investment is, and the fruits and joys of regular investing in equity.
All right, and if you want more help with starting a portfolio, of course, Dhirendra and I are here to help you on the show, and we'd be glad to help you. But be careful about the investments you make and make sure you understand them. That should be the first yardstick. Only start an investment that you can understand. Dhirendra, let's now take a look at the fund we're reviewing this week. We're looking at the UTI Equity Fund. Avan is here with an introduction. Avan.
Thanks, Faye. The fund under the scanner this week is the UTI Equity Fund, formerly known as the UTI Mastergain 92. This fund was launched in May 1992 as a close-ended fund and later became an open-ended fund in January 1997. The UTI Equity Fund is a heavily diversified fund with a portfolio of over 70 stocks, higher than the category average of 40 stocks. The fund manager aims to minimize volatility by reducing its dependency on any particular stock. The fund has been a strong performer in good and bad market cycles and has consistently done better than its peers since 2008. Over the last 5 years, the fund has been in the top 2 quartiles in its category, climbing really close to the highest performers. The fund is given an annualized return of 21% over its lifetime. Let's juggle some numbers to give you a better point of view. If you invested 1,000 rupees in this fund when it launched, you would have 8,988 rupees today. So despite its good positioning and clearly articulated strategy, should you remain invested in this fund? Let's find out. With that, it's back to you, Faye.
All right, Avan, thank you for that introduction. Dhirendra, UTI equity over the last 5 years, its performance really has, surprised a lot of the street. It's done so well. It's also managed to recover really well over the last 1 year. What is your review of the fund right now? The last time we rated it, you gave it 4 stars. Are you ready to upgrade this one as well?
Yes, last year this fund struggled. It barely was able to, beat its benchmark. And relative to other options, it struggled. And the fund turned conservative. In fact, if you recall, last year and a half back, this fund was reclassified. It was a large and mid-cap fund based on its portfolio allocation. And it, with more than 80% of its portfolio based on its 3-year, 6-monthly full portfolio disclosure, it got reclassified as a large cap fund, and so did many other funds. So and that took its toll, but that came in very handy, and it has helped the fund recover as well. Of course, I would say that this fund has made a remarkable comeback. And it has stuck to basic tenets, which is have a high quality portfolio, adequate diversification, and not have, keep away from anything questionable. And that has come in handy, that actually shows in a declining period. So I would say the way the fund has come back, the way it shows its focus, I'll be inclined to, upgrade its rating.
So shall we give it 5 stars then on the show for UTI equity, Dhirendra?
If you look at the complexion of its risk-adjusted rating, it has a very desirable complexion, which is it's low on rating, high on low on risk, and high on return, and that is what I expect from a large cap fund. And conservative investors tend to choose large cap fund, and it turns out to be a great choice today.
All right, a great choice there, UTI equity, 5 stars on Investors Guide. I'm going to pull in one more question. Purushottam has written in, Dhirendra, he's been making a monthly investment of 1,000 rupees in the ICICI Prudential Discovery Fund for the last 3 years. He wants to now increase his contribution by 5,000 rupees. Should he put the money in the same fund, or would you like to add another fund to his portfolio, Dhirendra?
ICICI Prudential Discovery is a very unusual fund. It has been a mid-cap fund based on our portfolio, classification of portfolio based on capitalization. But this is a value fund. It tries to capitalize on opportunity, underpriced opportunity, or ignored stocks, and it has been an outstanding performer. It has rewarded its investors very well. So, and somebody who has been investing for the last 3 years has been through the ups and downs. Be prepared to a struggling phase for this fund, but if you're a long-term investor, if there's the only fund which you have, it is worth investing. It'll always be good to have, if you as your stakes gets bigger, it's always good to diversify across, various strategies. If you have only this fund, this may not be the best way to approaching your long-term portfolio.
Dhirendra, that's a wrap on this particular segment. Thank you so much for joining us on the show and answering all of our questions. If you have a question for Dhirendra Kumar, write to us. Our email ID is at the bottom of your screen. It will be our pleasure to take your questions on the show. Coming up after the break, we'll tell you if gold ETF is really the best investment option for your infant daughter. That's on the other side. Don't go anywhere. Welcome back. You're watching Investors Guide in ET Now. Thank you for staying with us. Vishal Kapoor has come in this week to answer all of the questions you sent in on asset allocation. Vishal, thank you so much for joining us. It's always such a pleasure to have you on the show. Our first question for you comes in from Pratap, who's just been blessed with a baby girl. Congratulations, Pratap. He wants to know, Vishal, if gold is a good investment for her future, should he use a gold fund or a gold ETF. He seems fairly set on the idea of using gold, although I wouldn't recommend using just gold as an investment. Combine it with equity and debt as well. But Vishal, what would you recommend he does?
For Pratap, if he's so clear that he wants to buy a gold fund or a gold ETF, I'm assuming somewhere that he wants to eventually convert this investment into jewelry for the child. And to that extent, it's a smart way to start saving for gold. Between the two, I would prefer an ETF because it's cheaper. But the process may need you to go through the stock exchange, and therefore you may have to have a demat account. If you don't have that and you want a simpler process, then a gold fund would serve the purpose as well, but it is slightly more expensive, marginally so. But the other thing we have to ask Pratap is that jewelry is not the only investment that he could make. He should consider other financial assets as well for the long-term portfolio and benefit of his child. And he should consider equity and fixed income to that. Maybe combined with gold, it may make a nice portfolio which will look at various needs that his girl child will have over the course of a life.
Next question comes in from Gauri, who's 36 years old. She wants to put 4,000 rupees every month in a mutual fund. She wants to create long-term wealth over the next 5 years. I'm not sure if 5 years is long-term, Gauri. I'd like you to consider keeping that investment for a little longer. Vishal, where would you like her to invest that money?
For Gauri, I'm assuming again that she can take some bit of risk because she's still young, and provided that she can understand some of the risk associated with equity investing, I would recommend the aggressive or the growth portfolio for her. So choose a few of the large and mid-cap funds which will balance out various styles, and over the long term I think that would probably meet her objectives the best.
Pankaj Pradhan is written in, 25 years old, monthly income of 23,000 rupees. He can save 13,000 out of that. That's a lesson for all of us. He wants to know where he can invest that money to create a corpus for a down payment on a home in the future, and how he can save on tax. Vishal.
For Pankaj, I would make 3 recommendations. The first is that his term cover is not enough, so he should increase that. He should increase that to the 30 lakh to 50 lakh region. And that won't cost him a lot, so this is the right time to do that. The second is he should look at some health cover for himself. This is again early age, but it's important to start building that history when you can afford to do that very simply and at a very low cost. And the third is that he's got investments into PF and he's got some tax saving schemes going, but he could look at his remaining balance in an ELSS mutual fund. The ICICI approved tax plan or the DSP BlackRock tax fund may be 2 options. But given the increased limit that we now have, I think that would be a nice way to build a good long-term equity corpus while also saving tax under Section 80C.
Last question on the show. Navnath is written in. He's 39 years old and he can save 20,000 rupees every month. He wants to know where he can invest to save for his son's higher education. His son is in the 8th standard, so we don't have too much time, Vishal. Where would you like him to invest that money?
For Navnath, there are 2 ways we could look at his objective, because that's not absolutely clear right now. The first is that if the saving objective is for his son's graduation, which is he may need his money in 4 years, then I would prefer that he keeps it more tilted towards a fixed income heavy portfolio. He could have some bit of equity, maybe up to 20-25%. So an 80-20 fixed income to equity or a 75-20-25 portfolio may be useful for him. We have to monitor the equity portion very closely and bring it down to 0 closer to the 4 years. However, if he is looking at a much longer time frame, which is for the longer term or for post-graduation type of an expense, which may be 8 or 9 years down the line, then we could be a bit more aggressive with the investment allocation, subject to, of course, Navnath understanding the risk, and be more towards a balanced portfolio, which is about 65% in equity and 35% in fixed income. So I would think that somewhere in between is where he could be, depending on which side of the tenor is he more likely to need the money for his child's education.
Vishal, thank you so much for answering our questions on the show. It's always a pleasure to have you here.
Thank you.
If you have a question for Vishal or any of our other experts, write to us. Our email ID is at the bottom of your screen. You can reach me personally on Twitter at Faye D'Souza. Feel free to get in touch, give me any feedback you might have about the show. I love hearing from you. Thanks so much for watching.